Chris Parisi with Carl Mark Securities. I want to talk to you today about equity rollovers. In a lot of our transactions, the sellers are faced with the question, do they want to sell 100% of their business or do they want to roll over some equity? So what is an equity rollover? Simply, it's taking some of the existing shares in your business and reinvesting them into the business on a go-forward basis under a new buyer's control. So why would you want to do that? Well, lots of times owners are only seeking a certain amount of liquidity. They want to stay involved in the business and they want to continue to have some upside exposure to the future performance of the business. So you might have 100% of the shares and say, you know what, I'm going to sell 80% and roll over the other 20% into the future business. Sometimes our clients ask, well, what's the right percentage? That's a personal decision, but typically we see clients roll over anywhere from 15 to 25%. That's a combination of how much liquidity do you need today versus in the future, and how comfortable are you betting on the future performance of the company when ultimately you're not in control of final decisions. Another question we often get asked is, well, how does that affect my tax situation? The good news is, when you roll over equity, the amount that you've rolled over is almost in every case tax deferred. So let's say your business is worth $50 million and you've decided to sell 80% or 40 million and roll over the other 10 million. When your transaction closes, you'll only be taxed on the 40 million that you sold. The remaining 10 million that you rolled over will only get taxed in a subsequent sale whenever those shares are liquidated. So that's a little bit about equity rollovers. If you have any questions, please feel free to reach out to myself or anybody else on our team, and we'd be glad to help. Thank you.